The top story of the day is Fed Day, a widely predicted rate hike of about 25 basis points. Federal Reserve raising interest rates for the first time in 3 years. More rate hikes are expected to come throughout the year and into next year. Let's just dive right into it. Our first guest, Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Hello there, Marc. Thanks for joining us.
Hello.
So some of the things I noted, Fed Chair Jerome Powell saying, tangled supply chains due to the war by Russia and Ukraine. Financial markets have already priced in rate hikes. The Fed sees core inflation this year at 4.1% and overall inflation up by 4.3%, which is more than economist expectations. Your takeaways?
Yeah, I think my takeaway is what the market wasn't really prepared for was the projections for 2023, which envisage the Fed funds rate going above the so-called neutral rate of 2.5% by about 40 basis points. So, basically the Fed's saying we are basically going to try and get on top of this. Nevertheless, if you look at the dot plot, it's still talking about 25 basis points per meeting, which is relatively speaking aggressive, but it's not talking about anything more than that. I think really where there's a bit of triumph of hope over adversity is the GDP forecast has been revised down very sharply to 2.2 from 4. Quite natural given all the uncertainties that we've got with continued supply chain problems and indeed the war in the Ukraine. But it's making an assumption here that basically there isn't going to be a major hit to growth which will take us completely off course. And then that, I would say, is basically a real, that's more a hope than likely to be a reality. The things that are going on at the moment in the world, particularly the disturbance to all supply chains, are just going to are going to make things that much more difficult.
So with the vast money printing that has been going on over the past couple of years, the pandemic, a war in Ukraine, slowing down supply chains, high inflation, are we headed toward a global stagflationary recession?
I don't think we're necessarily headed towards a stagflationary scenario simply because we've still got a lot of pent-up demand out there. We haven't actually managed to rebuild the inventories which were lost through the lost production during the pandemic yet. And there is still a lot of pent-up demand, but we're going to be struggling to actually meet that pent-up demand. And that, in a certain sense, underpins growth, even if the recovery per se is going to be somewhat slower. But we are going to be in an inflationary environment, and there's no question about it. And the biggest threat, I think, to any economy in the world is the fact that the inflation that we've got all comes in the non-discretionary area: food, energy, and indeed housing. The housing part is something the Fed and other central banks can do something about because they're the ones who actually blew the big housing bubble that we've seen. It's not just in the United States, it's pretty much any country that one cares to think of, even a conservative country like Germany. But that's going to impinge on consumer spending. And if we get another rally in oil prices because perhaps things don't turn out as well, perhaps the underlying fundamentals of the oil market, like weak refining capacity, will basically just continue to impinge it. But that impinges on household spending. And for the time being, that's the biggest risk, that we actually see more of a consumer spending recession as a result of all this inflation that we've got.
I just want to spend a moment on how the markets are reacting. Bitcoin is up. U.S. stocks are as well. There's a surge in U.S. government bond yields. Explain the market reaction.
I think the market reaction is, I wouldn't call it violent. The only real violent reaction, a substantial reaction, has come in the Eurodollar curve with markets basically marking down Eurodollars by something between 15 and 25 basis points, depending on which part of the curve further out. And that's really where the pain's being felt. And also we've got a flattening of the yield curve, quite significant one, which in principle basically tells us that the market is saying, well, if the Fed's going to tighten that much, then their GDP forecasts look rather optimistic. So I think the biggest risks that we've got at the moment, and this is the thing that where there's a disconnect between what's showing up in equity markets with a modest recovery from the initial knee-jerk down, is we've seen credit spreads widening. And at some point, equity markets are going to have to take note of the fact that actually not only have we seen treasury yields rise, but we've also seen credit spreads widening. So if you get a 25 basis point rise in 10-year treasury yields, what you're seeing is on top of that, another 25 points in credit spread widening. And that's bad news basically for companies who need to refinance, particularly in an environment where money markets are already starting to show the stress from the war in the Ukraine.
Mm-hmm. Add to that, Fed Chair Jerome Powell expects up to 7 rate increases this year. What is the significance of that? And when do you feel that the rate increases will start to have an effect in curbing rising inflation?
Well, monetary policy is basically geared by the interest rate instrument to blunt demand. Now, the problem we've got is this isn't a demand-side inflation problem. There is a reasonable demand, as I was talking about earlier, in terms of the pent-up demand, which will fade as we gradually get those supply chains working again, even if that takes a longer time. But it can't actually solve anything to do with supply-side problems in the energy market. It can't deal with anything to do with all the disturbances that we're going to get to agriculture. So the risk is that at some stage it's the inflation itself rather than monetary policy which really does the most damage, the most damage to the economy. And that's really where my problem lies. That we're actually if you've got supply side problems, the best tools for basically dealing with them are sunsetted legislation, i.e., legislation which has to be reviewed on a regular basis, to try and curb some of the impact of energy price rises above all on consumers. You're not going to curb the inflation by raising interest rates. All you'll do eventually is kill demand.
Mm-hmm. And finally, how do you expect this to impact Bitcoin?
Well, I think at the moment, really, the story around Bitcoin is more about, if we're fracturing the global system due to this in Ukraine and with excluding Russia effectively, largely from many parts of the global payment system, people are going to be looking at alternatives, and Bitcoin will certainly be one of them. The problem is, obviously, some of the interest in Bitcoin is far more speculative. And at the moment, I think all we've got is an extremely high volatility environment. And I cannot see how a high volatility environment is particularly good for that, because it basically, if we get rising real yields, and at the moment they're not really attractive, then the alternative assets such as gold, such as Bitcoin, basically become less attractive because the opportunity cost of investing in low yielding assets becomes, the opportunity cost of higher risk assets becomes higher, and the more defensive assets become slightly more attractive, though not that much more attractive. So we're still talking about an end rate. The Fed's projecting 275. People are still going to be looking at assets like Bitcoin, like high yield credit, basically as an alternative, because what they're going to get in money markets or in bonds is particularly unattractive, and particularly in a rising interest rate environment, particularly long duration assets are not attractive at all.